Good morning, good time of the day. This is Paul Sverdlin from the Ascending Abundance. Thank you so much for tuning into the channel. I explore various ways of making more money with the existing money that you have. It's great to retire by spending less, but it's wonderful to make more money with the existing money. And in this video series, I'm exploring office REITs. There's been a lot of pressure on commercial REITs, and the prices have gone down across the industry. We're looking for some ways to profit from this, find a company that we could invest in or the company to short sell. And that was the goal, and I've covered 2 REITs so far, and there was good comments. Thank you so much for everybody who commented. I much appreciate all my subscribers. There's only a very handful of you so far. This channel is newish. I post about 1 or 2 videos per week. So I truly appreciate any comment, any likes, even if you just say, hi, thanks, great video. That makes my day sometimes, because I'm doing this mostly for myself to just document my journey, but of course to share the information as well and somewhat educate anybody who is interested in learning how to invest and analyze companies, real estate, crypto, businesses, whatnot. I will do a video on real estate next. Anyway, over to the Crown Castles. One of the users of YouTube, my subscriber potentially, left a comment saying, hey, Alexandria is great, Kilroy is not so great, what about Crown Castle? So I did what I typically do, which I went on Google, went Crown Castle Investor Relations, but actually just typed it in, Crown Castle Investor Relations. You go into Investor Relations, just read on the company, see what they do. It's a 40,000 cell towers and 120,000 on air, under contract, small cell nodes. I would need to read what that is. I don't know what small cells are, but that's okay. It's a very quick read, about a minute. Anyways, my opinion of this company is going to be based on what I see in their financials. You look at the SEC filings. 10Q is the quarterly report, the most recent. I just clicked on PDF, and here's what comes up. Literally on, like, you can go here and see where the financial starts. It starts right here, like page 4. Zoom a little bit, and what do we see? Total assets, about 40 billion, 39 billion. This is in millions of dollars. So 39 billion in assets against 32 almost billion of liabilities. That tells me that these guys are super leveraged, and that's already a bit of a red flag. Look at what their assets are comprised of. There's Goodwill. That's the first thing I pay attention to. Goodwill of $10 billion out of the 39. That's pretty much equal, or actually more than their entire equity. So this Goodwill is only good if you buy a competitor and you overpay for them. You pay more than their assets are worth, you pay more than their intangibles are worth. Labels, contracts, any kind of copyrights, anything you can identify, that becomes your asset, tangible or intangible. And it's only what you paid above that that becomes a Goodwill. Needless to say, that Goodwill, it's not a trademark, it's not like, it's nothing at all that you could identify. It's just extra you overpaid. It could never be sold unless you're selling something like, I don't know, Procter & Gamble. In which case probably Goodwill has some value there, or Coca-Cola, just because it's such a brand, like all of their network value, the fact that their brand is super known, etc. For somebody like Crown Castle, I highly doubt this is worth anything. If the company is in any kind of trouble, this will be just poof out of the, out of their financials. It'll be reviewed by the auditor. An auditor will come in and say, you have to write this down. They will take a non-cash write down straight against their equity, and their equity just becomes zero. And this is ridiculous. But anyway, a lot of companies carry Goodwill. I have nothing to do with IFRS accounting. I cannot change how this is represented, but personally, as a CPA and a CFA, I am not. I'm saying this is a bullshit. This is a fake asset. Looking further, how much of their assets is truly in real estate? This is REIT, real estate income trust. Well, how much is in real estate? Well, actually just 15 billion out of the 39. And those 15 billion, those are not residential properties, those are not office buildings, those are cell towers and these small cells. Cell tower, as much as it is real estate, I don't know if that's actually appreciating in value. Probably is, maybe, I'm not an expert, but I would kind of be a little suspicious, because if you want to sell those cell towers, you have to go approach very specific set of buyers. And if anybody's in trouble, in terms of the industry overall, or there's new technological changes or whatever, then it may be tough to sell those. And I have no idea what the market value is. I don't know what the growth rate of those assets are. Really hard to estimate. And again, there's only 15 billion on the balance sheet, net of depreciation. So, I'd be a little wary of that. So balance sheet, already bunch of negatives and red flags, over leveraged through the eyeballs. Looking at income statement, typically on the REIT, I would say income statement is not the best of representations, because depreciation, amortization is not real. I mean, my own house, I could depreciate it, I could just take the write down over, say, 40 years, amortize it, but the truth of the matter, my house is appreciating in value most of the time, over decades. What about cell phone towers? I don't know. It probably has a useful life of however many decades, at which point it needs to be knocked down and a new one constructed. You can maintain it for a while, but just like any industrial building, it has a useful life, and I don't know if it grows in price just like my house does. I don't know. So if this depreciation is real, then I look at their margins, and net margin is that they're profitable, but very little. So 417 income on the 1.7 in net revenues. It's a reputable margin, but nothing to be really excited about. And also I look at their interest expense, given how much debt they have. Their interest expense is 202 compared to the overall net income, for example, net income of 418. So half of their income is interest expense. If interest expense doubles over the coming multiple years, then that income is just going to get wiped out. Now, hopefully they fixed it. I didn't really read that deeply. Hopefully they fixed it. Hopefully, they have some way to manage that problem. But interest rates have gone down, and I don't know if they're going to have zero impact on this REIT. Probably not so much. Over the years, this is going to grow, and it's going to impact their net income. Okay, another red flag. I also look at, do they buy back their own shares? Well, over the last quarter they didn't, so they're not buying back any shares. Okay, looking at their statement of cash flows. So operating cash flow, obviously good there, they're growing. You kind of back out all the non-cash charges and come up with the operating cash flows. Then I look at how much of that cash flow goes into capital expenditures, which is not the same as acquisitions. Acquisitions are separate. But their capital expenditures, just the maintenance, probably additions of new units, just the ability to continuously grow it. They're promising it growth in dividends, and that can only come from the expansion of the business. So to maintain their position and continue growing their dividends, they have to spend money. So about half-ish, just more than half of their operating cash flow goes into capital expenditures that are either maintenance or growth. We don't know the split or whatever. So that leaves them with what, 250, 260 million dollars to spend on dividends and anything else. And it's nice to have a little bit of extra, a little bit of anything else, However, looking at the cash flow from financing activities, I see that their dividends are 686, and it's up from 650 last quarter, so they're increasing their dividends. So the company is making less than it pays out in dividends, and it needs to spend on capital expenditures, and it needs to acquire potential competitors or just buy outright new property. That tells me that this is not sustainable. They're borrowing, they're already deeply in debt, they're borrowing to pay their dividends, And what happens to a company in terms of its stock performance? The stock performance is kind of following many other companies in the sector. It's down, but it's not down that dramatically. I mean, they went from, what is it, 190-ish down to 114. Nothing spectacular. It's not like they crashed 90% and you're bottom fishing. This thing could continue going down and down and down. This downtrend is not more than Alexandria, it's not more than Kilroy, it's not even more than Intel or maybe even Facebook. So why stick with the company that has so much debt, have got questionable borrowing policies, and on top of it all, what I don't really understand is how long this can continue. Because as soon as they say, oh, we're too much in debt, it's hard to refinance, interest rates are higher, this and that, it's impacting us, we need to rethink it. So what happens? They might resemble Lumen. Lumen is a company I've looked at a while ago. I actually liked them at that time. And the company was just steadily going down. They also investing in fiber. They also have some sort of network connection. They also do some sort of networking, just different style and different type, but nevertheless, they're in fiber telecommunications. At some point over here, like we're looking at weeks, so if we go to days, some point over here, they said, we're gonna just cut our dividend. Our dividend is not sustainable. We have so much debt. We need to preserve our capital. This is good for our shareholders. We're going to have so much more capital if we just stop paying those dividends or cut them in half or cut them in 3/4. Different companies do different things, but I've seen it time and time again. They just get over-leveraged, over-leveraged, over-leveraged. They promise that they will be wonderful, and then they say, oops, our capital structure is not so good. We need to cut that dividend either to 0 or maybe like 10 times, 4 times, whatever. And this is what happens. This is what happened to Lumen Technologies. They cut their dividend immediately. Like they went already from 11 to 6. Probably somebody knew something. I'm guessing somebody suspected something. And then as soon as they cut their dividend, it was just downhill from there. And the company is not recovered. Look at it, from $10 to $2.50. Like, you lost 75% of value if you just held it for less than a year. So I'm not saying the Crown Castle is necessarily a repetition of Lumen, but it could be. It could very well be. Look at this thing, 180 to 114. So if it repeats Lumen, it will go to, well, the graph is not allowing me to, but it will go to 30. And at that point, you will make a decision whether you still would want to invest in this company or you want to cut your losses. I wish them all the best. Hopefully they can perform at their stated objective of growing their dividends payments, 7 to 8% a year. They want to grow it, and their dividend yield right now is at 5.5-ish. Good luck to them. It's a steady, good business model on the surface, but shitty financials and not so good execution. I would not be raising dividends if I don't have operating cash flows to cover it, let alone to invest in other businesses and expand your portfolio. So thank you again for those comments, the suggestions. I'm really appreciative of anybody who subscribed or liked any of these videos. I post 1 or 2 per week. I wanted to post 2. Let's see if I can get back into that cadence. And next ones are probably going to be about real estate. Thanks so much for watching. We will connect next time. Thank you.